In this video, we'll be looking at Magic Formula Investing, a rules-based quantitative value investing strategy created by Joel Greenblatt. This strategy was popularized in 2005 in his book, The Little Book That Beats the Market, and accompanying that book is the website magicformulainvesting.com, which includes a free stock screener that applies the magic formula to the current subset of US stocks. Now, the way Joel Greenblatt laid out this strategy is effectively using the magic formula. You'll take a look at the top ranked stocks based on the stock screener, and you'll pick roughly 20 or 30 of those. From there, you would purchase those stocks, assuming an equal weighted position in each of them, and then hold those stocks for a year. This way you can potentially maximize after-tax returns, assuming you're not investing in a tax-deferred retirement account, by realizing long-term capital gains only after you've held for a full year, and realizing short-term capital losses by selling before the year ends. The idea being at the end of the year, you can sell all those stocks in the most tax-efficient manner, and then repurchase the next set of Magic Formula investing stocks at the start of the next year. On the website, there's a page for frequently asked questions, and one of the most common ones that I think probably most of us would have is, how does this screener actually work? So Joel explains here, and it's elaborated more in his book, but there's nothing necessarily special about the magic formula despite its name. And effectively what the screener is doing is looking for cheap stocks, using price to earnings multiple as a proxy for that, and also applying a quality factor, in this case looking at return on invested capital. Well, the exact specifics of those criteria are a bit of a black box and we don't get to see that. What I presume is happening is it takes a look at the company's return on invested capital over a period of years, and if it's high enough, it then applies a ranking to the price to earnings ratios of these companies. That's just my best guess, and I can't guarantee that's exactly what's happening. But regardless, one of the benefits of this screener is that it's free. It just requires you to sign up for an account. But once you do so, you can then use the Magic Formula Investing Stock Screener, and in this case, it allows you to set a minimum market cap. So if you want to potentially only apply this to larger cap companies or mid cap companies and above, you can do so. The default is companies of at least 50 million market cap or more, which in reality is actually quite small. So this is a very wide net we're casting. Clicking Get Stocks gets us the 30 stocks in our list for the Magic Formula Investing portfolio. Now, when I say Magic Formula Investing portfolio, is that we're actually going to create a portfolio out of these stocks. In fact, I've actually already set this up in a hypothetical portfolio, investing $100,000 across each of these 30 stocks. This is a view of the entire portfolio, and as you can see, each of these stocks is a roughly 3.3% allocation, or investing $3,333.33 into each of these positions, using fractional shares to make sure each amount is fully invested. This can be verified in the trade history in each of these spreadsheets, and I've also added a tracker position in both VOO and QQQ, which is the S&P 500 and NASDAQ index respectively. The reason I have 5 cents invested in each of them is really just to serve as a tracker position so we can see how these portfolios have performed compared to the S&P 500 and the NASDAQ over the next year. Going back to our main dashboard, you can see that the positions are evenly split between each company, but we can also take a look at it from another perspective, in this case of the stock sectors each company represents, as well as their relative market capitalization. When we initially set up the screener, we set a minimum market capitalization of 50 million, but that still produced a wide range of stocks across various sizes. Microcap stocks, or stocks with a market capitalization between 50 million and 300 million, represented about 23% of the portfolio, or about a quarter. The largest market cap representation was from small caps, or companies with a market cap of around 300 million to 2 billion. Mid-caps from 2 billion to 10 billion represented about another quarter of the portfolio at 26%, and the small slice of the portfolio were large cap companies at around 10% of the total portfolio, or only 3 out of the total 30 stocks. Going back to the portfolio tracker, we can quickly see from the market cap over here those 3 large cap stocks. In this case, one of them is HP, another is Altria Group, and the third is Hologic. Now, I actually currently own Altria in my personal portfolio, so it's a bit encouraging to see here on this list. However, I will be the first to admit that, especially for a lot of these small and microcap companies, I have never heard of them before. This is potentially one benefit of using a screener like this, is you get exposed to a wider range of companies which you probably wouldn't be looking at otherwise. Now in the instructions for the magic formula, it suggests that you can eliminate any stocks that you don't want in the portfolio, but for our purposes here, we won't be making any eliminations from the portfolio, and we'll simply be purchasing an equal weight of all 30 positions. Part of the reason for this is just to see how the strategy would work in practice without any human intervention. Interestingly, going back to the dashboard, we can see how the portfolio looks from a stock sector perspective. In fact, it's actually relatively concentrated in a few sectors. In this case, stocks in the healthcare sector make up well over a third of the portfolio. The consumer cyclical sector is the next biggest component, making up roughly 27% of the portfolio. Technology makes up an additional 20%, followed by consumer defensive at 13%, and then communication services at 3%, or just one stock out of the 30. What's interesting is that out of the 30 stocks, there were no stocks from the following sectors: financials, utilities, basic materials, looks like I had financials twice, real estate, energy, or industrials. Now, when you're running a more concentrated portfolio, typically you will see more sector concentration, so this isn't necessarily a bad thing. Personally, I'm quite interested to see how this portfolio performs over the next year. If you'd like to track and follow these yourself as well, I'll leave a link to the viewable version of this spreadsheet in the description and comments below. So let's say maybe you're interested in applying the magic formula for maybe a portion of your portfolio, but maybe not so keen on investing in so many micro and small cap companies, many of which you may not have heard of before. Well, fortunately, with the minimum market cap filter, we can increase that to a threshold where maybe it makes a little more sense in your mind to apply the magic formula investing strategy. In this case, I'm going to raise that minimum market cap to 300 million or eliminate all of those micro capitalization stocks from the portfolio. And this will get us a new list of 30 stocks, although many of these stocks we've seen before, as it's simply all the large, mid, and small cap companies, but just the micro caps are removed and replaced with other non-micro cap companies. So I went ahead and put this in its own separate portfolio as well, so we can track it alongside with the full one that includes the micro cap companies. Large cap companies now make up a larger portion of this portfolio, not too surprisingly, at around 23%. Mid caps now represent about a third, and the remaining 44% are small cap companies. Interestingly, the sector concentration in healthcare actually increased, now is about 40%, and consumer cyclical increased as well at about 30%. So those two sectors alone make up 70% of this new portfolio. Technology is at 10%, consumer defensive also at 10%, followed by communication services at roughly 7%, and industrials at 3% or one stock out of the 30. I do notice one stock, Cigna, a large cap company, has been included in this portfolio that wasn't in our prior. Is again one of the stocks that I own in my personal portfolio, so nice to see here, but that doesn't guarantee performance over the short term. It'll be interesting to see how these companies perform both individually as well as in aggregate as a group. My guess is we'll likely see quite a range of performance, especially among the small and mid cap companies. Now what if you say, Michael, I don't want any small caps in the portfolio? Well, don't worry, we've got you covered. Raise the minimum market cap to 2 billion, and we get ourselves a new set of 30 stocks. As you can see, in this case, large caps now make up almost roughly 50% of the portfolio, with the remaining companies as mid-cap companies. Healthcare and consumer cyclical still dominate in terms of sector concentration, with the remaining four sectors again being technology, consumer defensive, communication services, and industrials. Given that these portfolios contain a significant amount of overlap, all of their overall aggregate performances will likely be highly correlated over the next year, though I still think it'll be interesting to see how they compare to each other. And finally, for completeness, let's just go ahead and get the large cap only stock list. In this case, we only have companies whose market cap is above 10 billion in market capitalization. You can see that here, with large cap representing 93% of the portfolio, we have one mega cap company, and that is Cisco, with a market cap of over 200 billion. And the one mid-cap company isn't an error, it's Dick's Sporting Goods, which is right around that 10 billion market capitalization. Based on current prices, it looks like it's just under that number right now. Healthcare is still the most dominant sector concentration at 40%, but communication services is now the second largest at 20%. Consumer cyclical, technology, consumer defensive, and industrials make up the four remaining sectors, and still no representation from the other sectors across this portfolio. So with $100,000 invested in each of these four hypothetical portfolios, we're going to track how their performance is over the next year. And again, you can check and see the current performance at any time using the links in the description. Now, probably one of the biggest questions is this even worth doing at all? Does this actually work or outperform, let's say, the S&P 500 over a longer period of time? Well, looking back, Joel Greenblatt has provided some statistics on that, in which case he backtested the returns from 1998 to 2004 and saw that the magic formula produced returns of above 30% annualized, well more than double the S&P 500's roughly 12.5% annualized return over that period. Now, a couple clarifications on this statement. One is that backtested results aren't always reliable and or predictive of future results. Given enough historical data, you can make a model that would be perfect for what happened in the past, but this can run into the problem of overfitting, which can cause the strategy to be either impractical or just not work in the present day or for the future going forward. Additionally, from the period in 1998 to 2004, value investing based on more of a quantitative strategy in terms of maybe looking at the lower priced earning stocks and simply purchasing those worked rather well. Since then, or at least from 2010 to 2021, growth stocks have significantly outperformed value stocks by traditional measures like price to earnings. This can make it much more difficult for a value-oriented strategy like the magic formula investing to outperform the S&P 500 when you have the outperformance of growth stocks carrying the index. However, I do still think there's merit for the magic formula investing or other rules-based quantitative strategies in finding opportunities that may not be there in an index. For instance, I specifically remember seeing GameStop on the magic formula investing list from 2019 to 2020. Now it's no longer on that list, but had one used the magic formula investing to purchase a basket of stocks and included GameStop within that list, at even just a 3% initial allocation, that one holding would have allowed the portfolio to significantly outperform the S&P 500 over each of those periods. Now, obviously, this is an extreme example and we'll likely not see another GameStop-like scenario again. That being said, the magic formula screener was able to pick up on what might have been the most contrarian value investment at that time, one which many probably didn't take seriously until the price started to reflect the true value. Now, when it comes to quantitative value models, while I don't use the magic formula directly, I do use a quantitative value strategy for myself when looking at stocks that I might be interested in purchasing. This is reflected in the ValueQuant model, a quantitative value investing model that I built, which in practice works very similarly to the magic formula investing strategy. Effectively, I have a list of pre-screened stocks for quality and then rank them based on their relative valuations. In this case, the valuation isn't necessarily based on a single metric like price to earnings, but it's based on what my price target is for the stock and how close or relative the stock is trading to that price target. In this case, this is a list of my B tier stock rankings with the A tier on a separate tab, which can help me look and quickly see which stocks are close to what I think would be an attractive buying opportunity for the long term. I can also get a quick glance of the company's historical performance over different time periods to be aware of any meaningful price dips that could be a buying opportunity. In general, there are several benefits for using a rules-based quantitative strategy when it comes to investing. One is there's less emotion. You're not as likely to get caught up emotionally in the price swings of a stock, whether that be on the upside or downside. Additionally, once you have a quantitative model or strategy set up and in place, you may not need to spend as much time investing while still making quality investing decisions. This is because by doing a lot of the research once up front, you can set yourself up with a process that makes future updates to your valuation and models much more streamlined and simple. This can simplify the decision-making process because you know once you trust the process that usually the decisions are fairly reasonable. For instance, if something pops up in my ValueQuant model as a buy and I have some cash set aside, it probably would be in my best interest to purchase some of that stock. Now, this is obviously no guarantee, especially in the short term, that the stock will perform to my expectations, but based on the reasoning and valuation work I put in beforehand and the lower price, I generally think that the odds are in my favor. In the year or so that I've been using this model, that's turned out to be true and has worked out fairly favorably. If you're interested in checking out my specific ValueQuant model, you can do so in the link in the description below. But overall, I just want to expose you to the idea of a quantitative rules-based investment strategy and how that could potentially be implemented in your portfolio. It'll be interesting to see how the magic formula portfolios perform over the next year, and it'll be really interesting to see how they perform compared to the index. Obviously, a year is still a very short time period, so it's likely we will see some variation in returns. That being said, if we keep up this experiment over a longer time frame, I think we'll have a much more valuable data set to make the determination if this strategy still holds in today's investing environment. If you haven't already, definitely subscribe for more content like this. Otherwise, thank you so much for watching. My name is Michael, and I will see you in the next video.